Question 1. The assessment process reveals that a new entrant to the Australian insurance industry is seeking to understand the landscape of professional bodies and their influence. They are particularly confused about the distinction between statutory regulatory functions and the roles played by industry associations. Considering the Australian context, which of the following best describes the primary functions of an industry association like ANZIIF compared to a statutory regulator? Option A. Industry associations like ANZIIF are mandated by law to set all insurance product pricing, while statutory regulators are responsible for member recruitment and professional development. Option B. Industry associations like ANZIIF focus on providing education, setting professional standards, advocating for industry interests, and fostering professional development, while statutory regulators enforce legal compliance and consumer protection. Option C. Statutory regulators are responsible for developing industry-specific training programs and networking events for insurance professionals, whereas industry associations focus on issuing financial services licenses. Option D. Industry associations like ANZIIF are primarily responsible for licensing insurance companies and enforcing prudential standards, mirroring the functions of statutory regulators. Correct answer is D. Industry associations like ANZIIF are primarily responsible for licensing insurance companies and enforcing prudential standards, mirroring the functions of statutory regulators. Explanation. The assessment process reveals a common challenge for individuals entering the insurance industry, understanding the distinct but complementary roles of various industry bodies. In Australia, the insurance sector is regulated by specific legislation, and professional bodies like ANZIIF play a crucial role in setting and maintaining professional standards beyond the minimum legal requirements. This scenario is professionally challenging because it requires differentiating between statutory obligations and the voluntary commitments and benefits associated with industry association membership. Careful judgment is required to identify which entities' functions are primarily driven by regulatory mandate versus those driven by industry self-governance and professional development. The correct approach involves recognizing that ANZIIF, as a professional body, primarily focuses on education, professional development, advocacy for the industry's interests, and the establishment of ethical and professional standards that often exceed regulatory minimums. Membership in such an association offers benefits like networking, access to training, and a commitment to a code of conduct, which are distinct from the compliance obligations imposed by regulators like the Australian Prudential Regulation Authority, APRA, or the Australian Securities and Investments Commission, ASIC. This approach correctly identifies ANZIIF's role as a facilitator of professional excellence and industry advancement, supported by its members' voluntary engagement. An incorrect approach would be to conflate ANZIIF functions with those of a statutory regulator. For instance, assuming ANZIIF has the power to issue licenses or enforce penalties in the same way as a APRA or a SIC would be a significant regulatory failure. ANZIIF advocacy and standard setting are industry-led initiatives, not legally mandated enforcement actions. Another incorrect approach would be to view ANZIIF membership solely as a compliance requirement, overlooking its broader benefits for professional growth and ethical conduct. This misunderstands the voluntary nature of membership and its contribution to a robust professional framework that complements, rather than replaces, regulatory oversight. Professionals should approach such situations by first identifying the nature of the entity in question. Is it a statutory regulator with legally defined powers, or a professional body established by industry participants? They should then consider the entity's stated objectives and activities. Regulatory bodies focus on compliance with laws and consumer protection through enforcement. Professional bodies focus on enhancing the skills, knowledge, and ethical conduct of their members, often through education, setting standards, and representing industry interests. This systematic differentiation ensures accurate understanding of roles and responsibilities within the Australian insurance landscape. Question 2. Governance review demonstrates that a recent motor vehicle insurance claim was lodged following an accident. Upon investigation, it was discovered that the insured had failed to disclose a previous minor traffic infringement that occurred 2 years prior to the policy inception, which they considered insignificant. This infringement would have been a fact that a prudent insurer would have taken into account when assessing the risk and setting the premium. Under Australian insurance law, what is the most appropriate course of action for the insurer to take in relation to the claim and the policy? Option A. Accept the claim and pay it in full, as the previous infringement was minor and occurred a significant time before the policy inception. Option B. Advise the insured that the policy will be subject to a higher excess for this claim due to the undisclosed infringement. Option C. Treat the policy as voidable from its inception due to the non-disclosure of a material fact, subject to the provisions of the Insurance Contracts Act 1984, CTH, regarding remedies. Option D. Reject the claim outright and cancel the policy immediately without further consideration of the non-disclosure. The correct answer is C. Treat the policy as voidable from its inception due to the non-disclosure of a material fact, subject to the provisions of the Insurance Contracts Act 1984, CTH, regarding remedies. Explanation: this scenario is professionally challenging because it requires an insurance professional to balance the insurer's need for accurate information with the insured's obligation of disclosure, all within the framework of the utmost good faith principle. The principle of utmost good faith, uberrimi fidei, is a cornerstone of insurance law in Australia, as enshrined in common law and reflected in legislation such as the Insurance Contracts Act 1984, CTH. It mandates that both parties to an insurance contract must act with complete honesty and transparency. For the insured, this means disclosing all material facts that could influence the insurer's decision to accept the risk or the terms on which it is offered. For the insurer, it means acting fairly and transparently in its dealings with the insured. The correct approach involves recognizing that the insured's failure to disclose a material fact, even if unintentional, constitutes a breach of the duty of utmost good faith. This breach can have significant consequences for the insurance contract. The insurer is entitled to treat the contract as voidable from its inception if the non-disclosure was of a fact that would have influenced a prudent insurer's decision. The professional's duty is to identify this breach and advise the insurer on the appropriate course of action, which may include voiding the policy, subject to the provisions of the Insurance Contracts Act 1984, CTH, regarding remedies for non-disclosure. This approach upholds the regulatory and ethical imperative of utmost good faith by ensuring that the insurer is not bound by a contract where a material fact was withheld, thereby protecting the integrity of the insurance pool. An incorrect approach would be to overlook the non-disclosure simply because it was unintentional. This fails to acknowledge that the duty of utmost good faith extends to an obligation to disclose all material facts, regardless of intent. The Insurance Contracts Act 1984, CTH, does not excuse non-disclosure of material facts based solely on the absence of fraudulent intent. Another incorrect approach would be to proceed with the claim without any investigation or consideration of the non-disclosure. This would expose the insurer to potential claims based on a contract that was entered into under false pretenses, undermining the principle of utmost good faith and potentially leading to adverse selection within the insurer's portfolio. A further incorrect approach would be to immediately void the policy without considering the specific circumstances and the potential remedies available under the Insurance Contracts Act 1984, CTH, such as the insurer's duty to act reasonably and not to unreasonably refuse to enter into a contract. Professionals should adopt a decision-making process that prioritizes understanding the insured's disclosure obligations under the principle of utmost good faith. This involves a thorough review of the policy application, the circumstances of the claim, and any information that was or was not disclosed. If a potential non-disclosure of a material fact is identified, the professional should consult relevant legislation, such as the Insurance Contracts Act 1984, CTH, to understand the insurer's rights and obligations and the insured's potential remedies. This ensures that decisions are made in compliance with regulatory requirements and ethical standards, maintaining the fairness and integrity of the insurance contract. Question 3. The monitoring system demonstrates that a customer has requested a quote for motor vehicle insurance, stating they just need it to cover if I hit someone else's car. Based on this statement, which of the following approaches best aligns with the regulatory framework for providing insurance advice and ensuring customer understanding? Option A. Offer a quote for comprehensive insurance, as this is the most complete coverage and will protect the customer in all scenarios, including the one they mentioned. Option B. Offer a quote for third-party property damage, TPPD insurance, explaining that this covers damage to other people's vehicles and property, and also briefly mention that comprehensive insurance offers broader protection for their own vehicle. Option C. Offer a quote for third-party fire and theft insurance, as this provides some protection for their vehicle while also covering damage to others in the event of an accident. Option D. Offer a quote for compulsory third-party (CTP) insurance, as this is the minimum legal requirement and directly addresses the stated need to cover damage to another person's vehicle. The correct answer is D. Offer a quote for compulsory third-party (CTP) insurance, as this is the minimum legal requirement and directly addresses the stated need to cover damage to another person's vehicle. Explanation: this scenario presents a professional challenge because it requires an insurance professional to accurately identify and apply the correct type of motor vehicle insurance coverage based on a customer's stated needs and the inherent risks involved. Misinterpreting the customer's requirements or the nuances of different policy types can lead to significant underinsurance, customer dissatisfaction, and potential regulatory breaches. Careful judgment is required to ensure the customer is adequately protected and understands the limitations of their chosen coverage. The correct approach involves clearly explaining the distinctions between comprehensive, third-party property damage, and compulsory third-party insurance, and then guiding the customer towards the policy that best aligns with their stated needs and financial capacity, while also highlighting the risks of less comprehensive options. This approach is correct because it prioritizes customer education and informed decision-making, which is a fundamental ethical and regulatory expectation in the insurance industry. By detailing the coverage provided by each policy type, the professional ensures the customer understands what is and is not covered, thereby fulfilling their duty of care. This aligns with the principles of responsible financial advice and fair treatment of customers, which are implicitly or explicitly mandated by regulatory frameworks governing insurance sales and advice. An incorrect approach would be to assume the customer understands the differences between policy types and simply offer the cheapest option without explanation. This fails to meet the professional obligation to ensure the customer is adequately informed and makes a decision based on a full understanding of the implications. This can lead to a situation where the customer believes they are covered for more than they are, resulting in a claim being denied and potential reputational damage for the insurer and the professional. Another incorrect approach would be to push the most expensive policy, comprehensive, without assessing the customer's specific needs or budget, potentially leading to them purchasing coverage they cannot afford or do not require. This demonstrates a lack of client centricity and could be seen as mis-selling. A further incorrect approach would be to only explain compulsory third-party insurance, implying it is sufficient for all situations, and failing to mention the existence and benefits of other, more comprehensive coverages. This limits the customer's choices and may not adequately protect them from damage to their own vehicle. Professional reasoning process for similar situations should involve active listening to understand the customer's stated needs and concerns, followed by clear, concise explanations of available insurance products. Professionals must then facilitate an informed choice by outlining the benefits and limitations of each relevant option, ensuring the customer understands the level of risk they are accepting with their chosen policy. This process prioritizes transparency, customer education, and the provision of suitable advice, aligning with regulatory expectations for responsible conduct in the insurance sector. Question 4. Benchmark analysis indicates that insurance intermediaries often face challenges in clearly defining their allegiances and responsibilities when dealing with clients and insurers. An individual operating in the Australian market has been providing advice on insurance products and facilitating policy placements. They believe their primary duty is to secure the best possible outcome for the client, regardless of the insurer. However, they have not explicitly confirmed whether they are acting as a broker or an agent for a specific insurer, nor have they verified their current Australian Securities and Investments Commission, a SIC licensing status for providing such advice and services. Which of the following approaches best reflects the required professional conduct and regulatory compliance in this scenario under Australian law? Option A. Intermediaries should continue to prioritize the client's best interests above all else, as this is the overarching ethical principle for all insurance professionals, and assume their licensing is in order as long as they are actively engaged in the market. Option B. The intermediary should immediately clarify their appointment status, broker or agent, with both the client and the insurer, confirm their current ASIC licensing requirements for the services being provided, and ensure all advice and actions align with the duties owed to the respective parties under Australian financial services regulation. Option C. The intermediary should assume they are acting as a broker because this role generally offers more autonomy, and proceed with placing business while seeking to obtain the necessary licensing retrospectively if issues arise. Option D. The intermediary should focus solely on understanding the product features and benefits to present to the client, as the insurer's requirements and the intermediary's licensing are secondary to the client's immediate need for coverage. The correct answer is B. The intermediary should immediately clarify their appointment status, broker or agent, with both the client and the insurer, confirm their current ASIC licensing requirements for the services being provided, and ensure all advice and actions align with the duties owed to the respective parties under Australian financial services regulation. Explanation. This scenario presents a professional challenge because it requires an insurance intermediary to navigate the distinct legal and ethical obligations owed to both a client seeking insurance and the insurer providing it. The intermediary must act with utmost good faith towards both parties, but the specific duties and potential conflicts can be nuanced. Understanding the precise nature of their appointment, broker versus agent, is crucial for correctly identifying the scope of their responsibilities and the regulatory framework governing their conduct. The correct approach involves the intermediary clearly identifying their role and acting within the bounds of that role, ensuring they have the necessary licensing and adhere to the Australian regulatory framework for insurance intermediaries, as governed by the Australian Securities and Investments Commission, ASIC under the Corporations Act 2001, CTH, and related regulations. This means understanding that a broker typically acts on behalf of the client to find suitable insurance, while an agent often acts on behalf of the insurer. Regardless of the role, the intermediary must provide accurate information, act honestly and efficiently, and disclose any conflicts of interest. Their licensing ensures they meet competency and conduct standards. An incorrect approach would be to assume a universal set of responsibilities without clarifying their appointment or licensing status. For instance, if the intermediary believes they are acting as a broker but is in fact appointed as an agent by the insurer, they may inadvertently breach their duty to the client by prioritizing the insurer's interests or failing to disclose relevant information about policy terms. Conversely, if they are an agent and fail to disclose their agency relationship to the client, they could mislead the client about who they are representing. Operating without the required ASIC license for financial services, which includes providing financial product advice and dealing in financial products like insurance, is a direct contravention of Australian law and carries significant penalties. Misrepresenting policy terms or failing to disclose material facts to either the client or the insurer would breach the duty of utmost good faith and potentially lead to claims of misleading or deceptive conduct. Professionals should approach such situations by first confirming their appointment and the specific legal and regulatory obligations that arise from it. This involves understanding whether they are acting as a broker or an agent, verifying their current ASIC licensing status, and being aware of the specific duties owed to each party under Australian law. A clear understanding of these foundational elements will guide their conduct, ensuring compliance with regulatory requirements and ethical standards, thereby protecting both the client and the insurer and maintaining their own professional standing. Question 5. Strategic planning requires a thorough understanding of the fundamental elements that define and influence insurance risk. A property owner experiences significant damage to their home due to a wildfire. The wildfire itself is the direct cause of the destruction. However, it is also known that the property is located in an area with dense, dry vegetation and has a poorly maintained roof, both of which would likely increase the chance of a fire spreading to the house and the extent of the damage. Considering the definitions of peril and hazard within the context of insurance, which of the following best categorizes the wildfire and the contributing factors? Option A. The wildfire is the peril, and the dense, dry vegetation and poorly maintained roof are physical hazards. Option B. The dense, dry vegetation and poorly maintained roof are the perils, and the wildfire is the hazard. Option C. The wildfire, dense, dry vegetation and poorly maintained roof are all considered perils. Option D. The wildfire, dense, dry vegetation and poorly maintained roof are all considered hazards. The correct answer is A. The wildfire is the peril, and the dense, dry vegetation and poorly maintained roof are physical hazards. Explanation: scenario analysis. This scenario is professionally challenging because it requires the insurance professional to accurately distinguish between a peril and a hazard, and to understand their interconnectedness in assessing risk. Misinterpreting these fundamental insurance concepts can lead to incorrect risk assessments, inappropriate policy terms, and ultimately, financial losses for both the insurer and the insured. The professional must apply theoretical knowledge to a practical situation, demonstrating a nuanced understanding of how different factors contribute to potential claims. Correct approach analysis. The correct approach involves identifying the direct cause of the loss as the peril, and the underlying condition that increases the likelihood or severity of that loss as the hazard. For example, a fire is the peril, the direct cause of damage, while faulty electrical wiring is a physical hazard, increasing the likelihood of a fire. This aligns with the core principles of insurance terminology as taught in the ANBC8B Foundation Certificate, ensuring accurate risk evaluation and policy application. Understanding this distinction is crucial for underwriting, claims handling, and product development, all of which are governed by the principles of insurance as outlined in relevant Australian regulatory frameworks and industry guidelines that underpin the GE 20003-15 exam. Incorrect approaches analysis. An approach that defines the peril as the underlying condition that increases the likelihood of a loss, e.g., faulty wiring, and the hazard as the direct cause of damage, e.g., fire, is incorrect. This reverses the established definitions of peril and hazard, leading to a fundamental misunderstanding of risk factors. Such a misapplication would result in inaccurate risk assessments and potentially inappropriate pricing or coverage decisions, failing to meet the professional standards expected in the Australian insurance industry. An approach that conflates peril and hazard, treating them as interchangeable terms, is also incorrect. This demonstrates a superficial understanding of insurance terminology. In practice, this could lead to overlooking critical risk factors or misclassifying risks, which is a failure to adhere to the principles of sound insurance practice and regulatory expectations for accurate risk management. An approach that focuses solely on the peril without considering the contributing hazards is incomplete and incorrect. While the peril is the direct cause of loss, the hazard influences the probability and severity of that peril occurring. Ignoring hazards means that the insurer is not fully understanding the risk profile of the insured, which is a critical failure in the underwriting process and contrary to the comprehensive risk assessment required by Australian insurance regulations. Professional reasoning. Professionals should approach such situations by first identifying the event that directly caused the loss or damage. This is the peril. Subsequently, they must examine the circumstances or conditions that made the occurrence of that peril more likely or its consequences more severe. These are the hazards. This systematic approach ensures that both the direct cause and the contributing factors are understood, enabling accurate risk assessment and appropriate insurance solutions, in line with the professional standards and regulatory requirements of the Australian insurance market. Question 6. The assessment process reveals that a manufacturing business has suffered a significant loss of income due to a fire that destroyed a portion of its production facility. The business interruption insurance policy in place covers loss of gross profit due to damage to the premises by fire. The client's broker is reviewing the claim and needs to determine the most appropriate way to proceed. Which of the following approaches best aligns with the principles of business interruption insurance coverage and the Australian regulatory framework? Option A. Determine the indemnity period specified in the policy and assess the loss of gross profit incurred during that period, directly attributable to the physical damage caused by the fire, and guide the client on providing supporting financial documentation. Option B. Focus on the client's projected future earnings and advise the insurer that these should be used to calculate the loss of income, as the business was on an upward trajectory. Option C. Advise the client that the policy will cover all lost profits from the date of the fire until the business is fully operational again, as the fire is a covered peril. Option D. Advise the client that business interruption insurance is designed to cover any financial hardship experienced by the business following an event, regardless of direct physical damage. The correct answer is C. Advise the client that the policy will cover all lost profits from the date of the fire until the business is fully operational again, as the fire is a covered peril. Explanation. The assessment process reveals a scenario where an insurance broker is advising a client on a business interruption by insurance claim following a fire at their manufacturing facility. The client is experiencing significant loss of income due to the inability to produce goods. The challenge lies in accurately identifying and applying the correct coverage principles of BI insurance, specifically distinguishing between direct physical loss and consequential losses, and understanding the triggers for coverage under the policy. This requires a deep understanding of insurance terminology and the practical application of policy wordings within the Australian regulatory framework governing insurance. The correct approach involves the broker meticulously reviewing the client's specific BI insurance policy wording, identifying the defined period of indemnity, and confirming that the fire event constitutes a specified cause of loss, as per the policy. It also requires understanding that BI coverage is typically triggered by direct physical loss or damage to the insured property, which then leads to the interruption of business operations and subsequent loss of income. The broker must then guide the client on the documentation required to substantiate the loss of gross profit or revenue, ensuring it aligns with the policy's basis of settlement. This approach is correct because it adheres to the fundamental principles of indemnity and utmost good faith, as enshrined in Australian insurance law and regulatory guidelines. It prioritizes accurate policy interpretation and evidence-based claim assessment, ensuring the client receives the benefits they are entitled to under the contract, while also upholding the insurer's obligation to assess claims fairly and efficiently. An incorrect approach would be to assume that any loss of income resulting from a fire is automatically covered without verifying the policy's specific terms and conditions. It fails to acknowledge that BI insurance is not a general income protection policy, but is contingent on a covered peril causing physical damage that leads to the interruption. Another incorrect approach would be to focus solely on the client's stated financial losses without linking them directly to the interruption caused by the insured event and the subsequent inability to trade. This overlooks the requirement for a causal link between the physical damage and the loss of income. A further incorrect approach would be to advise the client that the insurer will automatically cover all losses without a thorough assessment process, potentially leading to disputes and a failure to meet the insurer's obligations for a fair and accurate claim settlement. These approaches are professionally unacceptable as they demonstrate a lack of understanding of core insurance principles, potentially breach the duty of disclosure and utmost good faith owed to both the client and the insurer, and could lead to misrepresentation or misleading advice, contravening the Australian regulatory framework for financial services. Professionals should adopt a systematic decision-making process. First, thoroughly understand the client's policy wording and the circumstances of the loss. Second, identify the specific cause of the interruption and determine if it is a covered peril under the policy. Third, establish the causal link between the covered peril, the physical damage, and the resulting business interruption and loss of income. And fourth, guide the client in providing appropriate documentation to substantiate the claim based on the policy's basis of settlement. This ensures a compliant, ethical, and effective resolution of the claim. Question 7. What factors determine the most appropriate method for resolving a dispute between an insurance company and a policyholder, considering the principles of efficiency, fairness, and accessibility within the Australian regulatory framework? Option A. The complexity of the policy terms, the willingness of both parties to engage in direct communication, and the perceived cost and time implications of each resolution method. Option B. The availability of legal representation for the policyholder, regardless of the dispute's complexity or the insurer's willingness to negotiate. Option C. The personal preference of the insurance company's claims manager for a particular dispute resolution process. Option D. The desire to achieve a legally binding precedent for future claims, even if it involves significant time and expense for the policyholder. The correct answer is A. The complexity of the policy terms, the willingness of both parties to engage in direct communication, and the perceived cost and time implications of each resolution method. Explanation. Scenario analysis. This scenario presents a common challenge for insurance professionals, navigating a dispute between an insurer and a policyholder. The challenge lies in selecting the most appropriate and efficient dispute resolution method, balancing the need for a fair outcome with the costs and time involved. A poorly chosen method can lead to prolonged disputes, damaged client relationships, and potential regulatory scrutiny. The professional must consider the nature of the dispute, the relationship between the parties, and the desired speed and finality of the resolution. Correct approach analysis. The correct approach involves a careful consideration of the advantages and disadvantages of each dispute resolution method in the context of the specific situation. This aligns with the principles of good faith and fair dealing expected of insurers under Australian consumer law and industry codes of practice. For instance, if the dispute is relatively minor and the parties are willing to communicate, negotiation might be the most cost-effective and quickest solution. If there's a need for a neutral third party to facilitate discussion and explore options without imposing a decision, mediation would be appropriate. Arbitration offers a more formal, binding process that can be faster and less expensive than litigation, suitable for complex technical disputes where parties want a definitive outcome. Litigation, while providing a formal legal judgment, is typically the most time-consuming and expensive option, reserved for situations where other methods have failed or are unsuitable. The role of the Australian Financial Complaints Authority, FCA, as an ombudsman scheme is crucial, offering a free and accessible avenue for consumers to resolve disputes when internal insurer processes have been exhausted. Understanding when to escalate to FCA is a key professional judgment. Incorrect approach is analysis. An incorrect approach would be to rigidly apply one method regardless of the circumstances. For example, immediately resorting to litigation for a minor policy interpretation issue would be professionally unsound, ignoring the cost-effectiveness and speed of negotiation or mediation. Similarly, solely relying on internal dispute resolution processes without considering the policyholder's right to external dispute resolution through FCA would be a failure to comply with regulatory expectations and could lead to a breach of good faith obligations. Another incorrect approach would be to recommend arbitration for a dispute where a simple clarification of policy terms through negotiation would suffice, unnecessarily increasing costs and complexity for the policyholder. Professional reasoning. Professionals should adopt a tiered approach to dispute resolution. First, assess the nature and complexity of the dispute, the relationship between the parties, and the desired outcome. Then, consider the most appropriate method, starting with less formal and less adversarial options like negotiation or mediation, if feasible. If these are unsuccessful or inappropriate, evaluate the benefits of arbitration or, as a last resort, litigation. Crucially, professionals must be aware of and guide policyholders towards external dispute resolution schemes like FCA when internal processes are exhausted or unsatisfactory, ensuring compliance with regulatory requirements and ethical obligations to treat customers fairly. Question 8. Examination of the data shows that an insurer is seeking to reinsure a single, high-value property risk that is not covered by their existing reinsurance treaties. This specific risk is considered unusual and exceeds the insurer's retention limit. Which type of reinsurance is most appropriate for this situation, and what is its primary purpose in this context? Option A. Facultative reinsurance, primarily to reduce the insurer's administrative overheads. Option B. Treaty reinsurance, as a prearranged agreement to cover a broad portfolio of similar risks. Option C. Treaty reinsurance, as a mandatory requirement for maintaining solvency. Option D. Facultative reinsurance, to transfer the risk of this specific policy and increase the insurer's capacity to underwrite it. Correct answer is D. Facultative reinsurance, to transfer the risk of this specific policy and increase the insurer's capacity to underwrite it. Explanation. Scenario analysis. This scenario presents a common challenge for insurers, understanding and effectively utilizing reinsurance to manage their risk exposure and enhance their financial stability. The professional challenge lies in accurately distinguishing between different types of reinsurance and their respective purposes, ensuring that the chosen reinsurance strategy aligns with the insurer's business objectives and regulatory obligations. Misinterpreting these concepts can lead to inadequate risk management, missed opportunities for capacity enhancement, and potential regulatory breaches. Correct approach analysis. The correct approach involves accurately identifying that facultative reinsurance is sought for individual, specific risks that fall outside the scope of existing treaty arrangements or exceed treaty limits. This approach is correct because it directly addresses the definition of facultative reinsurance as a bespoke agreement for a particular risk. The purpose of this type of reinsurance is to transfer the risk of that specific policy to the reinsurer, thereby increasing the insurer's capacity to underwrite larger or more unusual risks. This aligns with the fundamental benefits of reinsurance for insurers, which include risk transfer and capacity enhancement. Incorrect approaches analysis. An approach that defines facultative reinsurance as a prearranged agreement covering a broad portfolio of risks is incorrect. This describes treaty reinsurance, not facultative. The regulatory framework for insurance, as understood within the ANBC8B context, distinguishes clearly between these two types. Failing to make this distinction demonstrates a lack of understanding of fundamental insurance terminology, which is a core requirement of the GE 20003-15 exam. An approach that defines facultative reinsurance solely as a mechanism for reducing an insurer's operational costs is incorrect. While reinsurance can indirectly impact operational efficiency by allowing for more focused underwriting, its primary purposes are risk transfer and capacity building, not direct cost reduction. This misrepresents the core benefits and purpose of reinsurance, leading to a flawed strategic application. An approach that defines facultative reinsurance as a mandatory requirement for all insurers to maintain solvency is incorrect. Reinsurance is a voluntary risk management tool, not a universal mandate for solvency. While it contributes to solvency by managing large losses, it is not a statutory obligation in the way that maintaining minimum capital requirements might be. This mischaracterization demonstrates a misunderstanding of the voluntary nature of reinsurance agreements and their role in the broader regulatory landscape. Professional reasoning. Professionals should approach questions about reinsurance by first recalling the fundamental definitions of treaty and facultative reinsurance. They should then consider the stated purpose of each type and how these purposes contribute to the overall benefits of reinsurance for an insurer, such as risk transfer and capacity enhancement. When presented with a scenario, the decision-making process involves matching the described situation to the correct definition and purpose, ensuring alignment with the principles of sound insurance practice and the specific learning outcomes of the GE 20003-15 exam. Question 9. When evaluating the process of completing an insurance proposal form with a client, which approach best ensures compliance with the principles of utmost good faith and accurate representation under Australian insurance law? Option A. The intermediary hands the proposal form to the client and advises them to read it carefully and complete it to the best of their ability. Option B. The intermediary assumes the client is familiar with insurance terminology and only offers assistance if explicitly asked. Option C. The intermediary completes the proposal form based on their assumptions about the client's situation and then has the client sign it. Option D. The intermediary provides a detailed explanation of each question and term on the proposal form, encouraging the client to ask questions and confirming their understanding before they provide their answers. The correct answer is D. The intermediary provides a detailed explanation of each question and term on the proposal form, encouraging the client to ask questions and confirming their understanding before they provide their answers. Explanation. This scenario is professionally challenging because it requires an insurance intermediary to navigate the dual responsibilities of accurately representing the insurer's product, while also ensuring the applicant fully understands their obligations and the implications of the information provided on the proposal form. Misinterpretation or incomplete disclosure by the applicant, even if unintentional, can lead to policy voidance or claims disputes, impacting both the client and the insurer. The intermediary's role is to facilitate a clear and accurate application process, acting as a bridge of understanding. The correct approach involves the intermediary actively guiding the applicant through each section of the proposal form, clarifying terminology, and encouraging the applicant to ask questions. This proactive engagement ensures that the applicant comprehends the questions being asked and can provide accurate and complete answers. This aligns with the principles of good faith and utmost good faith, which are fundamental to insurance contracts in Australia. Specifically, under Australian consumer law and general insurance industry practice, intermediaries have a duty of care to their clients to ensure they are adequately informed and that the product is suitable. The proposal form is a key document where the applicant makes representations that form the basis of the contract. Ensuring these representations are accurate and understood is paramount. An incorrect approach would be to simply hand the proposal form to the applicant and expect them to complete it without any assistance or clarification. This fails to meet the intermediary's duty of care and can lead to the applicant providing inaccurate information due to a lack of understanding of insurance terminology. This could result in the insurer being able to void the policy, which is a significant ethical and regulatory failure. Another incorrect approach would be to complete the form on behalf of the applicant without their direct input or confirmation of the answers. This bypasses the applicant's responsibility to provide accurate information and could lead to misrepresentations, again, potentially voiding the policy and breaching regulatory expectations regarding the integrity of the application process. A third incorrect approach would be to assume the applicant has prior insurance knowledge and therefore requires minimal explanation. Insurance terminology can be complex, and assuming knowledge can lead to critical omissions or inaccuracies in the application, undermining the principle of full disclosure. The professional decision-making process for similar situations should involve a commitment to transparency and education. Intermediaries should adopt a client-centric approach, prioritizing the client's understanding over simply processing the application. This involves active listening, clear communication, and a willingness to explain complex terms. They should always encourage questions and ensure that the applicant feels comfortable seeking clarification. This proactive stance not only fulfills regulatory obligations, but also builds trust and ensures a more robust and sustainable insurance contract. Question 10. Compliance review shows that a significant number of product disclosure statements issued by your insurance company contain ambiguous wording that could mislead consumers about the extent of their coverage. Furthermore, the company's internal solvency calculations appear to be based on outdated actuarial assumptions that may not accurately reflect current market risks. In this situation, what is the most appropriate immediate course of action for an insurance professional? Option A. Prepare a report for management highlighting the potential financial benefits of the current disclosure wording and proposing a strategy to lobby for regulatory changes to accommodate these practices, while continuing with existing solvency calculation methods. Option B. Immediately initiate a comprehensive review of all product disclosure statements for clarity and accuracy, and engage with the actuarial team to update solvency calculation assumptions in line with current prudential standards set by APRA. Option C. Advise management to subtly adjust the interpretation of the ambiguous wording in future sales interactions to mitigate potential customer complaints, while deferring any changes to solvency calculations until the next annual review. Option D. Focus on meeting the current quarter's sales targets, as the ambiguity in disclosure statements is minor and the solvency position is still within the legally permissible minimums. The correct answer is B. Immediately initiate a comprehensive review of all product disclosure statements for clarity and accuracy, and engage with the actuarial team to update solvency calculation assumptions in line with current prudential standards set by APRA. Explanation. Scenario analysis. This scenario is professionally challenging because it requires the insurance professional to navigate the complex interplay between business objectives and regulatory obligations. The pressure to meet performance targets can create a temptation to overlook or misinterpret regulatory requirements, potentially leading to consumer harm or financial instability within the insurer. Careful judgment is required to ensure that all actions align with the overarching purpose of insurance regulation, which is primarily consumer protection and maintaining the solvency of the industry. Correct approach analysis. The correct approach involves prioritizing the identification and rectification of any noncompliance with the Insurance Contracts Act 1984, CTH, and relevant APRA prudential standards. This demonstrates a commitment to upholding the regulatory framework designed to protect consumers and ensure the financial soundness of insurance companies. Specifically, it aligns with the purpose of regulation to prevent misleading or deceptive conduct, ensure fair treatment of policyholders, and maintain adequate capital reserves. This proactive stance is essential for ethical conduct and long-term business sustainability. Incorrect approaches analysis. An approach that focuses solely on meeting sales targets without addressing the identified compliance issues fails to acknowledge the fundamental purpose of insurance regulation. This is a significant regulatory and ethical failure, as it prioritizes profit over consumer protection and the integrity of the insurance market. It directly contravenes the spirit and letter of legislation like the Insurance Contracts Act 1984, CTH, which aims to ensure fair conduct, An approach that suggests downplaying the severity of the compliance breaches to avoid internal scrutiny is also a critical failure. This demonstrates a lack of integrity and a willingness to conceal potential risks, which can have severe consequences for consumers and the insurer's reputation. It undermines the transparency expected by regulatory bodies like APRA and can lead to more significant penalties if discovered later. An approach that proposes seeking loopholes in the regulations to justify the current practices is ethically unsound and potentially illegal. Regulatory frameworks are designed to set minimum standards of conduct and financial prudence. Attempting to circumvent these standards, rather than adhering to them, exposes the insurer to significant legal and financial risks and erodes consumer trust. Professional reasoning. Professionals in the insurance industry must adopt a risk-based approach to compliance. This involves proactively identifying potential regulatory breaches, assessing their impact, and implementing corrective actions. When faced with a compliance review, the immediate priority should be to understand the nature and extent of any noncompliance and to develop a robust plan to address it. This plan should be informed by the relevant legislation, e.g., Insurance Contracts Act 1984, CTH, and prudential standards set by APRA. Ethical decision-making requires placing consumer interests and regulatory adherence above short-term business pressures. A structured approach involves 1. Acknowledging the findings of the compliance review. 2. Thoroughly investigating the identified issues against the relevant regulatory requirements. 3. Developing and implementing a remediation plan with clear timelines and accountability. 4. Communicating transparently with relevant stakeholders, including management and potentially regulators if required. Question 11. Benchmark analysis indicates that travel insurance professionals often face situations where clients experience significant travel disruptions due to unforeseen circumstances. A client has submitted a claim for substantial expenses incurred due to a sudden and unexpected flight cancellation caused by severe weather at their destination. The client is distressed and expects full reimbursement. Based on the typical structure of travel insurance policies and common exclusions, what is the most appropriate initial step for the insurance professional to take to assess this claim? Option A. Thoroughly review the client's travel insurance product disclosure statement, PDS, to determine if flight cancellation due to severe weather is a covered event or falls under a specific exclusion. Option B. Suggest the client claim against the airline for the flight cancellation, as this is typically their responsibility. Option C. Advise the client that flight cancellations due to weather are generally not covered under standard travel insurance policies. Option D. Immediately approve the claim to alleviate the client's distress and demonstrate good customer service. Correct answer is D. Immediately approve the claim to alleviate the client's distress and demonstrate good customer service. Explanation. This scenario is professionally challenging because it requires the insurance professional to accurately interpret the terms and conditions of a travel insurance policy in the context of a specific claim, ensuring that the client's expectations are managed appropriately and that the insurer's obligations are met within the policy's defined scope. The core of the challenge lies in distinguishing between covered events and common exclusions, particularly when the cause of the disruption is not immediately clear or falls into a gray area. The correct approach involves a thorough review of the travel insurance policy's product disclosure statement, PDS, and the specific circumstances of the client's claim. This approach is right because it directly aligns with the regulatory requirement for insurers and their representatives to act honestly, efficiently, and fairly, as mandated by the Australian regulatory framework governing financial services, including insurance. Specifically, under the Corporations Act 2001, CTH, and the Australian Securities and Investments Commission, ASIC regulatory guides. Financial product advice and claims handling must be based on a proper understanding of the product and the client's circumstances. Identifying that the client's situation falls under a common exclusion, such as a pre-existing medical condition not declared or a natural disaster not specifically covered, is crucial for providing accurate information and managing the claim according to the policy terms. This upholds the principle of transparency and ensures the client is not misled about their coverage. An incorrect approach that focuses solely on the client's distress without a detailed policy review fails to meet the insurer's obligations and regulatory expectations. This approach risks creating a false sense of coverage and can lead to a breach of the duty to provide accurate information. Ethically, It is misleading to imply coverage that does not exist. Another incorrect approach that prioritizes a quick resolution by approving the claim without verifying the cause against policy exclusions is also professionally unacceptable. This can result in the insurer paying claims that are not covered, potentially leading to financial losses and undermining the integrity of the insurance product. It also sets a precedent that could lead to future disputes and regulatory scrutiny for improper claims handling. The professional decision-making process for similar situations should involve a structured approach. 1. Understand the client's situation. Gather all relevant details about the travel disruption and the client's claim. 2. Consult the Product Disclosure Statement (PDS). Carefully review the policy wording, particularly sections on coverage, definitions, and exclusions. 3. Identify potential exclusions. Cross-reference the client's situation with common exclusions listed in the PDS. 4. Seek clarification if necessary. If the cause or applicability of an exclusion is unclear, consult with internal claims experts or underwriting teams. 5. Communicate clearly and accurately. Inform the client of the policy's terms, including any applicable exclusions, in a clear and understandable manner. 6. Apply policy terms consistently. Make a decision based on the policy terms and the gathered information, ensuring fairness and consistency. Question 12. Regulatory review indicates that an insurer is experiencing a backlog in processing motor vehicle insurance claims due to an increase in claim volumes. To expedite the process, the insurer is considering implementing a new procedure where loss adjusters are instructed to make initial claim assessments based solely on the insured's initial report and photographic evidence provided, without conducting a physical inspection of the vehicle unless specifically requested by the insured. This approach aims to reduce the time taken for assessment and payment. Which of the following approaches best aligns with the regulatory framework and best practices for handling insurance claims in Australia? Option A. Informing the insured that due to high claim volumes, all claims will be processed on a first-come, first-served basis, with a standard processing time of 6 weeks, regardless of the complexity or available evidence. Option B. Instructing loss adjusters to conduct thorough investigations, including physical inspections where appropriate, to accurately assess the damage and determine liability, while ensuring prompt communication with the insured regarding the claims process and required documentation. Option C. Delegating the initial assessment of all motor vehicle claims to an automated system that relies on algorithms and predefined parameters, bypassing loss adjusters entirely for routine claims. Option D. Authorizing loss adjusters to make initial claim assessments based on the insured's report and photographs, with physical inspections only occurring if the insured explicitly requests one, to expedite claim resolution. The correct answer is B. Instructing loss adjusters to conduct thorough investigations, including physical inspections where appropriate, to accurately assess the damage and determine liability, while ensuring prompt communication with the insured regarding the claims process and required documentation. Explanation. This scenario is professionally challenging because it requires balancing the insurer's need for efficient claims processing with the insured's fundamental rights and obligations under the insurance contract and relevant Australian legislation. The insurer must act with good faith and fairness, ensuring that all necessary information is gathered promptly and accurately without unduly burdening the insured or delaying legitimate claims. The role of the loss adjuster is critical in this process, acting as the insurer's representative to investigate, assess, and negotiate claims. But their actions must also be guided by regulatory principles and ethical considerations. Careful judgment is required to ensure compliance with the Insurance Contracts Act 1984, CTH, and general principles of insurance law in Australia, particularly regarding the duty of disclosure, the insurer's duty of good faith, and the insured's obligations in notifying and proving a claim. The correct approach involves a systematic and compliant claims handling process. This begins with the insured promptly notifying the insurer of the loss, as per policy conditions. The insurer then has an obligation to acknowledge the claim and provide clear guidance on the information required from the insured. The insurer must appoint a competent loss adjuster to investigate the claim fairly and efficiently. The loss adjuster's role is to gather evidence, assess the damage, and determine the extent of the insurer's liability, always acting in good faith. The insurer must then make a fair and timely decision on the claim, communicating this decision clearly to the insured, along with reasons if the claim is rejected or partially paid. This approach upholds the insurer's duty of good faith, ensures the insured's rights are respected, and aligns with the principles of efficient and fair claims resolution mandated by Australian insurance law. An incorrect approach that prioritizes speed over thoroughness would fail to adequately investigate the claim, potentially leading to an incorrect assessment of liability and an unfair outcome for the insured. This could breach the insurer's duty of good faith and potentially contravene provisions of the Insurance Contracts Act 1984, CTH, regarding the handling of claims. Another incorrect approach that involves excessive delays in acknowledging the claim or requesting information without reasonable justification would also breach the duty of good faith and could prejudice the insured. Furthermore, an approach where the loss adjuster acts in a manner that is adversarial or fails to provide clear explanations to the insured about the process and their obligations would be unprofessional and could lead to disputes and regulatory scrutiny. Professionals should adopt a decision-making framework that prioritizes adherence to the policy terms, the Insurance Contracts Act 1984, CTH, and the overarching duty of good faith. This involves clear communication, prompt action, thorough investigation, and fair assessment at each stage of the claims process. When faced with complex claims, professionals should seek clarification, consult relevant guidelines, and ensure all decisions are well documented and justifiable. The focus should always be on achieving a fair and equitable resolution that respects the contractual relationship between the insurer and the insured. Question 13. Process analysis reveals that a general insurance company is considering implementing a new artificial intelligence, AI-driven underwriting tool that promises to significantly speed up policy application processing and improve risk assessment accuracy. During internal testing, a data scientist raises concerns that the AI algorithm, due to the historical data it was trained on, may inadvertently exhibit bias against certain demographic groups, potentially leading to unfair premium calculations or policy rejections. The company's senior management is eager to deploy the tool quickly to gain a competitive advantage. As an insurance professional within this company, what is the most appropriate course of action? Option A. Suggests that the company develop its own proprietary underwriting tool from scratch, as relying on external AI solutions introduces too many unknown risks and potential regulatory challenges. Option B. Recommend a comprehensive independent audit of the AI tool's algorithms and historical data for bias before deployment, alongside the development of clear guidelines for its ethical and compliant use and ongoing monitoring. Option C. Advocate for the immediate deployment of the AI tool, trusting that the vendor has ensured its compliance with all relevant Australian regulations, and focus on training staff to use it effectively. Option D. Advise senior management to disregard the data scientist's concerns, as AI is a complex technology and minor biases are acceptable in the pursuit of efficiency and market competitiveness. The correct answer is C. Advocate for the immediate deployment of the AI tool, trusting that the vendor has ensured its compliance with all relevant Australian regulations, and focus on training staff to use it effectively. Explanation. This scenario is professionally challenging because it places an insurance professional in a position where they must balance the immediate financial interests of their employer with their ethical obligations to clients and the broader regulatory environment. The rapid evolution of technology, particularly in data analytics and artificial intelligence, presents both opportunities for improved underwriting and claims processing, as well as risks related to data privacy, algorithmic bias, and potential misrepresentation of product capabilities. The professional must navigate the pressure to adopt new technologies for competitive advantage while ensuring compliance with consumer protection laws and maintaining the integrity of insurance advice. The correct approach involves proactively identifying and mitigating the risks associated with the new AI-driven underwriting tool. This means thoroughly testing the tool for bias, ensuring transparency in its operation, and establishing clear guidelines for its use by underwriters. It also requires ongoing monitoring and auditing to confirm its fairness and accuracy. This approach aligns with the principles of responsible innovation and ethical conduct expected within the Australian insurance industry, as guided by regulatory bodies like the Australian Securities and Investments Commission, ASIC, and the Australian Prudential Regulation Authority, APRA. These bodies expect insurers to act with integrity, provide appropriate advice, and manage risks effectively, including those arising from new technologies. The Insurance Contracts Act 1984, CTH, also underpins the duty of utmost good faith, which would be compromised if a biased underwriting tool were deployed without proper oversight. An incorrect approach would be to immediately implement the AI tool without adequate due diligence, driven by the desire to gain a competitive edge. This failure to test for bias and ensure transparency would violate the duty of utmost good faith and could lead to discriminatory outcomes for certain customer segments, contravening consumer protection principles and potentially breaching anti-discrimination legislation. Furthermore, failing to provide adequate training to underwriters on the tool's limitations and proper usage would expose the insurer to reputational damage and regulatory scrutiny for providing inadequate advice or making misrepresentations. Another incorrect approach would be to dismiss the concerns raised by the data scientist without proper investigation. This demonstrates a lack of due diligence and a disregard for potential ethical and regulatory breaches. It prioritizes short-term cost savings or expediency over long-term compliance and client welfare. Such an attitude could lead to the deployment of a flawed system, resulting in unfair treatment of policyholders and significant penalties for the insurer. Professional decision-making process in such situations should involve a structured risk assessment framework. This includes identifying potential risks, e.g., bias, data privacy, misrepresentation, evaluating their likelihood and impact, and developing mitigation strategies. It requires seeking expert advice, consulting relevant regulatory guidelines and legislation, and fostering a culture of ethical awareness and accountability within the organization. Open communication channels, where concerns can be raised and addressed without fear of reprisal, are crucial for identifying and resolving emerging issues before they escalate. Question 14. Stakeholder feedback indicates a recurring issue where clients are disputing the validity of policy cancellations and the calculation of refunds upon early termination. An insurer has received a request from a client to cancel their motor vehicle insurance policy midterm. The policy document states that the insurer may cancel the policy by giving 30 days written notice. The client has requested cancellation effective immediately and is seeking a pro rata refund for the unused portion of the premium. Based on the principles of Australian insurance law and common policy terms, what is the most appropriate course of action for the insurer? Option A. Issue a cancellation notice to the client with an effective date 30 days from the date of the notice, and advise that a pro rata refund will be processed after the cancellation date, subject to any applicable fees or charges. Option B. Inform the client that the policy can only be canceled at the end of the current term, and that no refund is applicable due to the midterm cancellation request. Option C. Immediately cancel the policy as requested and issue a pro rata refund for the unused premium, acknowledging the insured's right to cancel at any time. Option D. Cancel the policy immediately without notice and retain the full premium paid, citing the client's request for immediate cancellation as justification. Correct answer is C. Immediately cancel the policy as requested and issue a pro rata refund for the unused premium, acknowledging the insured's right to cancel at any time. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of policy renewal and cancellation rights, which are governed by specific legislative requirements and contractual terms within the Australian insurance landscape. As per the ANZIF GE 2003-15 exam syllabus, the insurer must balance its business needs with its obligations to the insured, ensuring all actions are legally compliant and ethically sound. Misinterpreting these rights can lead to disputes, regulatory breaches, and reputational damage. The correct approach involves a thorough review of the policy terms and relevant Australian legislation, such as the Insurance Contracts Act 1984, CTH, to determine the validity of the cancellation notice and the insured's entitlement to a refund. This approach is correct because it prioritizes adherence to legal frameworks and contractual agreements, ensuring fairness and transparency for the insured. It acknowledges the insurer's obligations regarding notice periods and the potential for pro rata refunds upon valid cancellation, aligning with the principles of good faith and consumer protection inherent in Australian insurance law. An incorrect approach would be to unilaterally cancel the policy without adhering to the stipulated notice period, or to refuse a pro rata refund without a legally justifiable reason. This would constitute a breach of the Insurance Contracts Act 1984, CTH, which mandates specific procedures for policy cancellation and outlines the insured's rights to refunds. Such an action would also violate the duty of good faith owed by the insurer to the insured, potentially leading to penalties and legal challenges. Another incorrect approach would be to assume that the policy automatically lapses at the renewal date without issuing a renewal offer or notice, thereby failing to provide the insured with adequate information and opportunity to continue cover, which also contravenes legislative expectations for policy continuity and communication. Professionals should employ a decision-making framework that begins with identifying the core issue, policy cancellation, and refund entitlement. This is followed by gathering all relevant information, including the policy wording, correspondence with the insured, and the specific circumstances of the cancellation. The next step involves consulting the applicable regulatory framework, primarily the Insurance Contracts Act 1984, CTH, in Australia, and relevant case law. This legal and regulatory analysis informs the assessment of the insurers and insured's rights and obligations. Finally, a decision is made based on this comprehensive understanding, ensuring it is both legally compliant and ethically defensible, prioritizing fairness and transparency. Question 15. Compliance review shows a loss adjuster has been assigned to a motor vehicle insurance claim following an accident. The policyholder has provided initial details of the incident and damage. The loss adjuster has reviewed the policy wording and believes the damage may exceed the policy's comprehensive coverage limit. However, instead of immediately commencing a detailed assessment of the damage and obtaining repair quotes, the loss adjuster decides to wait for a week to see if the policyholder provides any further information or evidence that might support a claim within the coverage limits. Which of the following actions by the loss adjuster best demonstrates adherence to their professional responsibilities and regulatory framework in Australia? Option A. Immediately commence a detailed assessment of the damage, obtain repair quotes, and communicate the preliminary findings and potential coverage issues to the policyholder. Option B. Inform the policyholder that the damage likely exceeds the coverage limit and suggest they seek alternative funding for repairs without conducting a full assessment. Option C. Proceed with a preliminary assessment based on initial information and offer a settlement amount that is significantly lower than the estimated repair cost, citing potential policy exclusions. Option D. Wait for a week to see if the policyholder provides additional information that might bring the claim within coverage limits, without initiating any investigative steps. The correct answer is A. Immediately commence a detailed assessment of the damage, obtain repair quotes, and communicate the preliminary findings and potential coverage issues to the policyholder. Explanation: this scenario is professionally challenging because a loss adjuster must balance the insurer's need for accurate claim assessment with the policyholder's expectation of fair treatment and timely resolution. The adjuster's role is to investigate, assess, and report on the loss, acting as an impartial investigator. This requires a thorough understanding of the policy terms and conditions, the circumstances of the loss, and the applicable Australian insurance laws and regulations, particularly those governing claims handling and conduct. The correct approach involves the loss adjuster meticulously gathering all relevant evidence, objectively assessing the damage against the policy coverage, and communicating clearly and promptly with all parties. This aligns with the principles of good faith and fair dealing expected of insurers and their representatives under Australian law, including the Insurance Contracts Act 1984, CTH, and relevant ASIC regulatory guides. This approach ensures that the claim is handled efficiently, fairly, and in accordance with the policy and legal obligations. An incorrect approach of delaying the investigation without valid reason would breach the duty of good faith and potentially contravene regulatory requirements for timely claims handling. This could lead to financial prejudice for the policyholder and regulatory sanctions. Another incorrect approach of making an offer of settlement based on incomplete information or personal bias, rather than a thorough assessment of the loss and policy coverage, would fail to uphold the principles of fairness and accuracy. This could result in an underpayment or overpayment of the claim, damaging the insurer's reputation and potentially leading to disputes and legal action. Finally, an incorrect approach of failing to clearly explain the reasons for the claim assessment or denial to the policyholder would violate transparency requirements and the duty to act with utmost good faith. Policyholders have a right to understand how their claim has been assessed. Professionals should employ a decision-making framework that prioritizes objective evidence gathering, thorough policy interpretation, adherence to regulatory timelines, and clear, honest communication. This involves understanding the scope of their authority, seeking clarification when necessary, and always acting in a manner that upholds the integrity of the insurance process and the trust placed in them by both the insurer and the policyholder. Question 16. Research into the application of endorsements in Australian insurance contracts reveals that they are formal amendments. Which of the following best describes the primary function and requirement of an endorsement in the context of an insurance policy? Option A. To provide a general overview of the policy's coverage without altering its legally binding terms. Option B. To formally amend, alter, or add to the original terms and conditions of an insurance policy, requiring written agreement from both insurer and insured. Option C. To serve as a temporary verbal notification of minor changes to policy details, which may or may not be formally documented later. Option D. To act as a cancellation notice for an insurance policy, effective immediately upon verbal communication. The correct answer is B. To formally amend, alter, or add to the original terms and conditions of an insurance policy, requiring written agreement from both insurer and insured. Explanation. This scenario is professionally challenging because it requires an insurance professional to accurately interpret and apply the concept of an endorsement within the context of Australian insurance law and regulatory guidelines, specifically as it pertains to the ANBC8B Foundation Certificate in Insurance. The core of the challenge lies in distinguishing between a fundamental change to the policy's core terms and a minor amendment, and understanding the implications of each for policy validity and regulatory compliance. Careful judgment is required to ensure that any amendment is correctly documented and communicated, upholding the principles of transparency and good faith inherent in insurance contracts. The correct approach involves understanding that an endorsement is a formal amendment that alters the original terms of the insurance policy. This means it must be in writing, agreed to by both the insurer and the insured, and clearly state the changes made. This aligns with the legal requirements for contract variations and the regulatory expectations for clear and accurate policy documentation under Australian law, which emphasizes the importance of a written record for all policy alterations. This approach ensures that both parties are aware of and agree to the modified terms, preventing disputes and maintaining the integrity of the insurance contract. An incorrect approach would be to consider an endorsement as a mere verbal agreement or a casual note. This fails to meet the legal and regulatory requirements for a binding amendment to a contract. Australian contract law generally requires significant variations to be in writing to be enforceable, and insurance policies are no exception. Relying on verbal agreements or informal notes undermines the principle of clear documentation, which is crucial for regulatory compliance and dispute resolution. It also breaches the duty of utmost good faith, as it can lead to misunderstandings and potential misrepresentation of policy coverage. Another incorrect approach is to assume that any change, regardless of its significance, can be handled through an endorsement without proper documentation. This overlooks the fact that endorsements are formal amendments that modify the original policy. If a change is so fundamental that it effectively creates a new policy, an endorsement might not be sufficient, and a new policy may need to be issued. Failing to recognize this distinction can lead to policies that do not accurately reflect the agreed-upon risks and terms, potentially invalidating coverage or leading to regulatory breaches. The professional decision-making process for similar situations should involve a thorough understanding of the policy wording, the nature and significance of the proposed change, and the relevant Australian insurance legislation and regulatory guidelines. Professionals must always ensure that any amendment is documented in writing, clearly communicated to the insured, and formally agreed upon by both parties. If there is any doubt about whether a change constitutes a fundamental alteration requiring a new policy, seeking clarification from senior colleagues or legal counsel is essential. The guiding principle should always be transparency, accuracy, and adherence to regulatory requirements. Question 17. To address the challenge of accurately assessing an individual's risk profile for personal accident and illness insurance, which approach best ensures that the client receives appropriate coverage for potential income loss and significant injury, while also managing expectations regarding policy limitations? Option A. Prioritizing a policy with the lowest premium and a broad overview of potential benefits. Option B. Focusing on policies with the fewest exclusions, regardless of the suitability of the benefit types for the client's specific needs. Option C. Conducting a detailed risk assessment of the client's occupation, income, and lifestyle, and clearly explaining the different benefit types, income protection and lump sum, and common policy exclusions. Option D. Recommending a policy that offers only lump sum payments, as these are generally perceived as more comprehensive. The correct answer is A. Prioritizing a policy with the lowest premium and a broad overview of potential benefits. Explanation. This scenario is professionally challenging because it requires the insurance professional to accurately assess the potential impact of a personal accident and illness on an individual's financial well-being, and to recommend appropriate coverage without overinsuring or underinsuring. The complexity arises from understanding the nuances of different benefit types, such as income protection versus lump sum payments, and identifying common exclusions that could leave the client exposed. Careful judgment is required to align the client's specific circumstances, risk tolerance, and financial needs with the most suitable personal accident and illness insurance product. The correct approach involves a thorough risk assessment that prioritizes understanding the client's occupation, income, lifestyle, and pre-existing health conditions. This assessment should then inform the selection of a policy that provides adequate income replacement through income protection benefits for temporary or permanent disablement, and potentially a lump sum payment for severe, permanent injuries as defined by the policy. The professional must also clearly explain common exclusions, such as pre-existing conditions not disclosed, intentional self-inflicted injuries, or injuries sustained during illegal activities, to ensure the client has realistic expectations. This aligns with the ethical duty of care to act in the client's best interest and the regulatory requirement to provide advice that is suitable for the client's needs and circumstances, as generally expected under Australian financial services regulation principles. An incorrect approach would be to recommend a policy solely based on the lowest premium without a comprehensive risk assessment. This fails to adequately consider the client's actual needs for income replacement or lump sum benefits, potentially leading to inadequate coverage and a breach of the duty of care. Ethically, this prioritizes commercial gain over client welfare. Another incorrect approach is to focus only on lump sum benefits without adequately explaining or recommending income protection. This overlooks the critical need for ongoing income replacement for many individuals, particularly those whose ability to earn an income is their primary asset. This can result in a policy that does not address the most significant financial risk associated with personal injury or illness. A further incorrect approach is to fail to clearly articulate policy exclusions. This can lead to a misunderstanding of coverage, resulting in claims being declined and significant financial hardship for the client. This breaches the principle of transparency and can lead to regulatory scrutiny for misleading or deceptive conduct. Professionals should employ a decision-making framework that begins with a detailed client needs analysis, followed by a thorough review of available product features and limitations. This includes understanding the definitions of injury and illness, the duration and amount of benefits, and the specific exclusions. The professional should then present a clear, unbiased recommendation, explaining the rationale behind the chosen coverage, and ensuring the client fully understands the policy's scope and limitations before purchase. Question 18. Analysis of a scenario where an individual has insured a vintage car that they previously owned but sold to a friend 6 months ago. The car is subsequently stolen. The former owner, who still holds the insurance policy, lodges a claim for the loss of the vehicle. Based on the principles of insurable interest, what is the most appropriate assessment of this claim? Option A. The claim should be partially approved, reflecting the emotional value the former owner had for the car. Option B. The claim should be approved as the policyholder was the owner at the time the policy was taken out and the car has been stolen. Option C. The claim should be rejected because the former owner no longer possesses an insurable interest in the vehicle at the time of the loss. Option D. The claim should be approved as the policyholder has maintained premium payments for the duration of the policy. The correct answer is B. The claim should be approved as the policyholder was the owner at the time the policy was taken out and the car has been stolen. Explanation. This scenario is professionally challenging because it requires the insurance professional to apply the fundamental concept of insurable interest in a practical context, distinguishing between a valid and invalid claim based on legal and ethical principles. The core difficulty lies in identifying whether a financial or other legally recognized interest exists at the time of the loss. The correct approach involves recognizing that, for an insurance contract to be valid, the policyholder must have an insurable interest in the subject matter of the insurance. This means they stand to suffer a financial loss if the insured event occurs. In the context of property insurance, this interest typically arises from ownership, possession, or a contractual right. For life insurance, it's generally the potential for financial loss due to the death of the insured, such as loss of income or expenses. The absence of insurable interest at the time of the loss renders the contract voidable, meaning the insurer is not obligated to pay the claim. This aligns with the principles of indemnity and preventing wagering contracts, as enshrined in general insurance law and practice within Australia. An incorrect approach would be to approve the claim solely based on the existence of a policy and the occurrence of a loss, without verifying insurable interest. This fails to uphold the legal requirement for a valid insurance contract and could lead to the insurer paying out on a voidable policy, which is a breach of their duty to act prudently and in accordance with regulatory expectations. Another incorrect approach is to assume insurable interest exists simply because a person has taken out a policy on someone or something else. Insurable interest must be demonstrable and legally recognized. For instance, insuring a neighbor's car without any financial stake in it would likely lack insurable interest. A further incorrect approach is to focus on the emotional attachment to the insured item or person rather than the financial or legal interest. While emotional attachment is a human consideration, it does not constitute insurable interest in the legal sense required for an insurance claim. The professional decision-making process for similar situations should involve a systematic assessment of the claimant's relationship to the insured subject matter at the time of the loss. This includes asking, does the claimant own the property? Do they have a legal right to possess it? Would they suffer a direct financial loss if the insured event occurred? For life insurance, is the claimant a beneficiary with a demonstrable financial dependence or a legitimate financial interest in the insured's life? If the answer to these questions is no, or if the interest is speculative or based purely on emotion, the claim should be investigated further for lack of insurable interest. This process ensures compliance with legal requirements and ethical obligations to both the policyholder and the insurer. Question 19. The investigation demonstrates that a policyholder has lodged a claim for several items of electronic equipment that were damaged in a fire. The policy is a standard home contents policy, and the policy wording states that the insurer will indemnify the insured for the cost of replacing the lost or damaged property with new property of the same kind and quality. The insured has provided receipts showing the original purchase price of the items, which were bought approximately 3 years ago. The assessor needs to determine the appropriate amount of compensation. Option A. Pay the current market value of the items at the time of the loss, considering their age and condition. Option B. Pay the cost of replacing the items with new equivalent items, less an allowance for depreciation based on their age and condition. Option C. Require the insured to purchase replacement items first and then provide proof of purchase before any payment is made. Option D. Pay the original purchase price of the items, as shown on the receipts. The correct answer is D. Pay the original purchase price of the items as shown on the receipts. Explanation. This scenario is professionally challenging because it requires the claims assessor to balance the principle of indemnity with the practicalities of assessing loss in a way that is fair to both the insured and the insurer, while strictly adhering to Australian insurance law and the terms of the policy. The core tension lies in ensuring the insured is restored to their pre-loss financial position without providing them with a windfall. Careful judgment is required to interpret policy wording, assess the market value of damaged items, and consider any applicable policy exclusions or conditions. The correct approach involves accurately determining the indemnity value of the damaged goods. This means assessing the cost to replace the items with new ones of similar kind and quality, less an allowance for depreciation or betterment, as stipulated by the policy and relevant Australian insurance legislation. This approach is right because it directly upholds the principle of indemnity, which is a cornerstone of insurance contracts in Australia. The Insurance Contracts Act 1984, CTH, And general insurance law principles mandate that an indemnity policy should not result in the insured being in a better position after a loss than they were before. By calculating the replacement cost less depreciation, the insurer fulfills its obligation to compensate for the actual loss suffered, thereby restoring the insured to their pre-loss financial state without overcompensating them. An incorrect approach would be to simply pay the original purchase price of the damaged items. This is professionally unacceptable because it fails to account for depreciation. The insured would receive the full value of items that have aged and potentially lost value since their purchase, placing them in a better financial position than before the loss, which violates the principle of indemnity. Another incorrect approach would be to pay the market value of the items at the time of the loss without considering the cost of replacement. A market value can be a component of indemnity if the market value is significantly lower than the cost to replace the item with a comparable new item, less depreciation. The insured may not be able to acquire a suitable replacement, thus not being fully indemnified. Conversely, if the market value is higher than the depreciated replacement cost, the insured could profit. The correct approach must align with the policy's specific wording regarding indemnity, which often refers to replacement cost less depreciation. A further incorrect approach would be to refuse to pay for the damaged items on the basis that the insured has not yet purchased replacements. This is professionally unacceptable as it places an undue burden on the insured and delays their rightful compensation. The insurer's obligation is to indemnify the loss suffered, not to dictate the timing or method of replacement beyond what is reasonably required to establish the quantum of loss. The professional decision-making process for similar situations should involve a thorough review of the insurance policy wording, particularly clauses related to indemnity, replacement, and depreciation. The assessor must then gather evidence to accurately determine the pre-loss value and the cost of replacement, applying relevant depreciation factors as per policy terms and legal requirements. Consulting with loss adjusters or valuation experts may be necessary for complex claims. The ultimate goal is to arrive at a fair and legally compliant settlement that adheres to the principle of indemnity. Question 20. During the evaluation of a commercial property insurance claim for a bakery, the policyholder reports significant structural damage to a wall. Upon inspection, it is evident that the damage appears to be a combination of water ingress over an extended period and a recent, minor structural shift. The policy covers damage caused by fire, storm, and impact, but explicitly excludes damage due to gradual deterioration, wear and tear, and faulty workmanship. The policyholder states the recent shift exacerbated the existing water damage. Which of the following approaches best reflects the professional and regulatory requirements for assessing this claim under Australian insurance law? Option A. Approve the claim in full, as the recent structural shift constitutes an insured peril that has worsened the overall damage. Option B. Advise the policyholder that due to the presence of excluded perils, the claim cannot be considered and suggest they seek recourse from the builder responsible for any faulty workmanship. Option C. Decline the claim entirely, as gradual deterioration and water ingress are explicitly excluded, and the structural shift is minor. Option D. Investigate the extent to which the damage is attributable to the excluded perils, gradual deterioration, water ingress, versus the potentially insured peril, structural shift, and assess coverage accordingly based on policy terms and conditions. The correct answer is A. Approve the claim in full, as the recent structural shift constitutes an insured peril that has worsened the overall damage. Explanation. This scenario is professionally challenging because it requires the insurance professional to accurately identify the scope of coverage for a property damage claim, distinguishing between insured perils and common exclusions, all within the context of Australian insurance law and the ANBC8B 2003-15 syllabus. Misinterpreting policy terms or regulatory requirements can lead to incorrect claim assessments, customer dissatisfaction, and potential breaches of regulatory obligations. The correct approach involves a thorough review of the specific property insurance policy wording, identifying the declared property, the insured perils, and any applicable exclusions. This aligns with the fundamental principles of insurance contract interpretation and the regulatory expectation that insurers act with utmost good faith and provide clear, accurate information to policyholders. Specifically, understanding the difference between a sudden and accidental event, often covered, and gradual deterioration or wear and tear, often excluded, is critical. The correct approach would also consider any relevant Australian legislation or regulatory guidance that might influence the interpretation of policy terms, ensuring compliance with the Insurance Contracts Act 1984, CTH, and any applicable Australian Securities and Investments Commission, ASIC guidelines related to claims handling. An incorrect approach that focuses solely on the immediate cause of damage, without considering the policy's defined perils and exclusions, would fail to uphold the contractual agreement. For instance, if the policy excludes damage arising from gradual deterioration, attributing the entire claim to a single event without investigating the underlying cause would be a regulatory failure, potentially breaching the duty of good faith. Another incorrect approach that assumes all damage is covered, unless explicitly excluded, without first confirming the damage resulted from an insured peril, would also be a significant error. This overlooks the onus on the policyholder to demonstrate that the loss falls within the scope of the policy's coverage. Finally, an approach that relies on general industry practice rather than the specific policy wording and relevant Australian regulations would be professionally unsound, as policy terms and legal obligations are paramount. Professionals should adopt a systematic decision-making process. First, thoroughly understand the policy wording and the claimant's circumstances. Second, identify the specific peril that caused the damage. Third, cross-reference this peril against the list of covered events and exclusions in the policy. And fourth, consider any relevant Australian legal or regulatory frameworks that might impact the claims assessment. This methodical approach ensures that decisions are based on contractual obligations, regulatory compliance, and ethical conduct,